Hello, everyone, and welcome to our webinar on benefits and retirement planning for private practices. Thank you for joining us today. My name is Katie Blycker. I am a CPA in our Client Advisory Services department. I've been at Lutz since about 2018, and
I am Chris Wagner. I run our retirement plans practice within the Lutz Financial area of Lutz, and I have been at Lutz since 2016.
perfect. So today, our agenda items and what we hope that you have as key takeaways. We're going to go over goals and challenges of retirement plans for private practices. We want to talk through how you can assess and refine your current retirement benefit strategy. And then we want to talk about some differences between custom 401k plans and a pooled employer plan. And then we also hope to through some different fiduciary responsibilities and governance consideration for practice owners under each of those different plans. Okay, so a little bit about Lutz, if anyone on this webinar is new to Lutz. Lutz was founded in 1980. We are headquartered in Nebraska. Our headquarters are in Omaha. We have offices in Lincoln and Grand Island, but we do serve clients across the country. We have 370 plus employees in what we consider our Lutz network. So our Lutz network includes the multiple divisions that we have developed over the years in order to serve our clients and future clients. So we have your typical public accounting firm, audit and assurance, client and advisory services, and tax. But we do truly pride ourselves on not being just a public accounting firm, but being more of a business solutions firm, so that we offer different resources to help our clients grow and solve problems. So we have Lutz Financial, which, as Chris mentioned, that is where he leads up the retirement plan services. We have our Lutz M&A group, we have our Lutz Talent group, and we have our Lutz Tech group. A lot of these divisions, formed as we saw our clients having needs and felt like we could provide an opportunity to help them solve those needs. So let's start. What are common goals of retirement plan practices? The first and probably the most important, we want to maximize contributions in a tax efficient way for doctors and other key employees. But at the same time, we also want to attract and retain our other employees with competitive benefits. This can be a retention or a recruitment tool used in the marketplace now. So this becomes a balancing act between those owner objectives and the employee outcomes. And at the same time, we hope to reduce or limit any administrative and fiduciary burden at the same time, which is a great segue into our common challenges for retirement plans. So the first really is that limited administrative capacity. Oftentimes there's a small team or really just one administrator that's juggling HR, payroll, compliance, and at the same time running the practice. If it's a doctor handling some of these duties, they're doing all of the above, plus seeing their patients as well. So the retirement plan duties really end up competing with patient care priorities or other priorities of growing the business. And then as there are new reporting requirements or regulations increase, this becomes an increased work and risk on that one person who is oftentimes already wearing so many different hats in the business. And then as complexity grows in the business and in the environment, the retirement plan environment, complexity grows as the practice grows.
And Katie, I was just going to ask a question. So oftentimes when we look at retirement plans of these practices, especially when it's been like a doctor or somebody who's been running that practice, you're in a lot of these board meetings and stuff. How many times would you say, one, that in those situations that doctor is really wanting to administer the retirement plan, and then two, that they even have the time to be able to continue to keep up with all the changes that are consistently happening?
Absolutely. I would say whether it's the doctor or the practice administrator, They often truly don't have the time to do this. Other things are falling to the bottom of the list, so that they can be compliant and get things done. But it's definitely not something they are, dying to do that gives them joy. It's, a part of their job that they enjoy. So it's definitely something I think most practice administrators or doctors that I work with would feel good about outsourcing or lessening that burden on their plate.
They don't wake up every morning and be like, gosh, I can't wait to go run my 401k today.
Not that I'm aware of.
Yeah, I just,
Is that when you wake up every
I have
morning?
not seen that either, but yes.
Okay. Next, we have widely varying compensation. This is true really any medical practice or dental practice. So, there are significant compensation gaps between doctors and your other staff. Because of this, one size fits all plans do not work in order for us to accomplish those goals that we previously mentioned. So if you currently have a design in place that is restricting owner contributions because it is truly treating all plan participants in the same way, that is really going to prohibit you from accomplishing the goals of a good retirement plan. And then finally, plan participants have different investment expectations and support needs. I think you have a wide range of individuals in your medical or dental practice. So, this means you have a wide range of financial and investment experience. Some of your participants are using brokerage accounts, others are not. Some of them have their own financial advisors who are helping them along the way. Some feel very comfortable with investment decisions, some do not. And you probably also have some employees that have no idea how the process works, what terms to use, where to even start.
Yeah, and a lot of times when we have conversations sometimes the doctors or decision makers, oftentimes they just look at the retirement plan from their lens, right? And they may have a much more in-depth knowledge of how investments work, of how retirement planning works, of how those kind of things work than their typical employee. So just always making sure that, when you are thinking about your retirement plan, maybe not all of your employees have that same level of expertise or sophistication as it goes along with it.
And I think being able to explain it too on the front end, we know the marketplace right now, it's really hard to hire people, whether that's a nurse, a dental hygienist, a receptionist, it's hard in the industry right now. So if you're able to explain these benefits on the front end too, it really could be a great recruitment and retention tool as well.
Absolutely.
Okay, Chris, so let's get into how plan designs can be structured in order to help us accomplish different goals.
Perfect. So thanks, Katie. There's going to probably be a lot of numbers and a lot of detail that's going to go into these remaining slides and conversations. But Katie hit on this earlier, and a lot of times when we have conversations with practices, um, maybe they've had a retirement plan in place, maybe they haven't. Um, but oftentimes when we start this conversation and we start digging into some of the details, oftentimes that doctor's practice typically they just don't know what they don't know, right? And it's just been kind of a let's set it, let's forget it. Oh, nothing's broken, so let's not even do a deep dive into this. And that thought process oftentimes can lead to not really maximizing this from a contribution standpoint, from an efficiency standpoint, not just for the doctors, dentists, owners, but also for the employees, as Katie mentioned, as a retention tool. So we'll walk through some of those misconceptions that we typically see, and then go through, you know, kind of a thought process on how to design a plan based on how much you want to make in contributions, typically from that ownership standpoint. So, and then also you see this plan funding hierarchy that we're going to go through in depth here on the left, and we're able to send that out to everybody if they want to take a look at it afterward.
We know it's very small on the screen.
It is, but we're going to kind of go through each one of those columns in each one of these slides. So, uh, first one, when we're having a conversation, whether it's somebody that's starting a retirement plan for the first time, or maybe they have a retirement plan in place, uh, the design that you see here is more common than it should be. Meaning, we see owners really just you know, having a retirement plan in place because they feel like they have to, right? And it's a benefit that they want to offer their employees and that their employees ask about when they're hiring them. So they put something in place without really diving in and doing a ton of due diligence on the potential of it. And when you do that, right, you can put a 401k plan in place. You see owners' contributions there at 24.5 up to 32,500. That is how much an individual can put into a 401k in 2026, right? Uh, they can make contributions either as pre-tax contributions up to those limits, or they can make those contributions as after-tax Roth contributions or a combination of both, right? Um, the problem is, and oftentimes, like a common question that I'll ask a doctor is, are you able to put in as much as you'd like? And again, we hear more than we should. No, I can't because my employees aren't putting enough in. And if your plan is just set up as a basic plan like this with maybe no employer contribution or some type of matching contribution, but it is not set up as a safe harbor plan, then the plan is subject to what we call discrimination testing. And oftentimes that leads to your highly compensated people or your doctors not even being able to maximize their contributions at this 24,500 or 32,000 if they're over the age of 50.
Chris, I'm going to stop you right there because
Yep.
I think we're going to refer to highly compensated employees throughout this presentation. So, what is considered a highly compensated employee in 2026?
Great question. So that would be somebody who, um, this year, that threshold from compensation would be $160,000. A highly compensated employee is also somebody who has 5% or more ownership, or is the spouse, son, daughter, um, parent of somebody who has 5% or more ownership. All of them would be considered highly compensated employees.
Perfect. So that's something to keep in mind throughout. And we forgot to mention this at the beginning, but please do send questions in the chat if you have any along the way. We can answer questions throughout or at the end.
Absolutely. So, given the limitations and oftentimes owners not being able to put in that full 24/5 or 32/5, um, it's very rare that a medical practice should not have a safe harbor plan. And when I reference safe harbor, that's just a design that just says, hey, as long as you offer a certain amount and a certain type of employer contribution to all of your eligible employees, then we're not going to worry about that deferral percentage discrimination test. So as long as we do this, then owners are going to be able to maximize their personal contributions, no questions asked. They don't have to worry about how much money the non-highly compensated employees are putting in. So the first step oftentimes is doctor says or owner says, you know what, I want to at least maximize my contributions at, I'm over 50 years old. I want to maximize my contributions at the $32,500 a year. Perfect. If you want to do that, then typically there's two ways to do that. One is we can do what's called a 3% safe harbor non-elective. And that just says, hey, as long as I provide a 3% of W-2 wages to my eligible employees, right? And there's various eligibility options that you can have, then I can maximize my contributions and also receive that 3%, no questions asked. Also, if I said, you know what, I don't want to give everybody 3%, I want to do a matching plan instead, then, there's a few different matching plans, but typically it's going to be you're going to have to match up to 4% in some formula or another. And in that situation, as long as I do that, again, I can maximize my contributions. We're assuming you're over 50 years old. You can put in up to your 32,500 and then receive either that 3% non-elective or a matching at 4%. And some thought process that we typically see there is there are uh, a lot of doctors or owners that will utilize that 3% um, because they feel like maybe their employees are not in a financial position to be able to put money in on their own. So they want to make sure that they're helping them towards their retirement in some way. And then there's another thought process that just says sometimes, you know what, I really love my employees. I really want to help them, but I want to make sure that they are putting some of their own money in order for me to put that money in. We'll come back to that 3% non-elective because if we want to start making additional contributions on top of that, that is going to be the route to go. So next one, let's assume doctor says, perfect. I was able to put my $32,500 in. I was able to get the, you know, 3% non-elective contribution on top of that. Can I do more? Right? And the answer to that is yes, right? And what we would do is we just then add what I call a third bucket to this retirement plan. And it's most commonly referred to as profit sharing. It's really a non-elective contribution because this contribution has nothing to do with the profits of the practice, right? But now what it does is it allows us, and again, remember, we're assuming that uh, the doctors involved in this example are both over the age of 50, right? Is it allows them to put in their 32,500, right? We're assuming that we're doing the 3% non-elective contribution, and I'll get to why that is for the safe harbor. And then we're able to put in an additional non-elective that is discretionary and that can be used from year to year, right? And what that would do for 2026 is it would be able to get you to a maximum of 80,000 for those two owners, right? So it becomes an excellent way for doctors to move money from business pocket, right? Get the tax deduction on that into their 401k and allow it to grow, right? So is when these are set up properly, is they really can be very good wealth building tools, not just for the owners, but by doing that, it also requires us to give some money to the employees. So oftentimes I'm asked, um, but if I give myself, right, a large non-elective contribution, and when I mean myself as the owner, don't I have to give that same amount to employees? And the answer to that is no, as long as our profit sharing formula is set up properly, right? And you'll see there in the company contributions, it's really what we use is cross-testing or new comparability as a way to calculate that, meaning we put everybody in their own categories and it allows us the most flexibility to give people different amounts. Now, whenever we give those owners or highly compensated people a contribution, there's going to be a minimum amount that's required to give everybody else. We're assuming in this example that it's a company that the demographics work out to be the most efficient that's there. So in this example, dollars to owners, $80,000 each, right? And oftentimes, in order to do that, we've seen it to where we only have to give those eligible employees up to a 5% contribution, right? Um, so when you look at, using a 40% tax rate, that means the two owners in this scenario are getting $160,000 that's going into their retirement plans, right? That would require us, if we have $1 million payroll, to put amongst our employees to put $50,000 in on their behalf, right? Gross tax savings is roughly about 84,000. So really, as long as we have the cash flows, when we consider the money that we just saved in taxes and the money that just went into our own accounts, right, we're saving about $34,000 a year to do that. Um, a few additional points on this. You can still do this, profit sharing contribution or non-elective contribution if you have a safe harbor match, or even if you don't have a safe harbor plan. Oftentimes, though, that is not the most efficient. And the reason for it is when we use a 3% non-elective contribution, safe harbor non-elective contribution, when we start making that profit sharing calculation, we're starting at a 3% baseline, meaning we're already getting to utilize that 3% and doing the contributions and testing. So oftentimes we can make it to where we only have to give those non-highly compensated employees a 2% contribution. Whereas if we have a matching program, right, then oftentimes we would probably have to give those employees a 5% non-elective contribution or profit sharing contribution in addition to this. So that's one of the biggest things that we see and changes that we make is a lot of practices have matching programs already set up versus the non-elective. Oftentimes we can increase owners' contributions significantly, uh, while keeping, oftentimes the employees' total contributions the same or just increasing them slightly by making that one change.
Chris, I have a few questions for you. On when we were looking at Safe Harbor, noted that the company contributions there have immediate vesting. What are you typically seeing on plans you're crafting today for vesting schedules for profit sharing?
Great question. So, as absolutely. So most of the time, not all the time, but most of the time, that safe harbor non-elective is going to have, immediate vesting. That money is theirs, right? But, you know, in professional practices, we still see the non-elective or profit sharing have up to a 6-year vesting. That's the most restrictive you can get. Really what it does is after year two, it just has 20% vesting every single year. And that is from their date of hire, right? So anybody who has been there for 6 years would be fully vested in any contributions that they have. The other part of that is you can have different eligibility. So it's not uncommon for us to see practices, with immediate or 6 months, or I mean 6 months, 60 days, 90 days, to where they're able to put their own money in and to where they're able to get the safe harbor contribution. But they have to be there at least a year before they're able to get any type of profit sharing contributions.
So lots of flexibility there, which is nice. We've also had the question, Chris, what if you had an employee, was not a highly compensated employee, but was someone that you still wanted to have a higher percentage of a contribution than maybe your other staff? Is that possible the way you have the testing set up?
Great question. It is. So, as long as we have the profit sharing formula set up to be new comparability with everybody in their own group, if you wanted to, you know, give Katie 5%, right, instead of 2, we could do that. And, Chris didn't do as well. I don't like Chris as much. I could give him 2%, right?
Okay.
So there's going to be a baseline minimum that's required for everybody, if the owners are taking something, but then, yeah, you can pick and choose.
Okay. Awesome. Okay, it looks like we have one question. On a safe harbor plan in the catch up for age 60 to 63, can I fund the full value of the safe harbor first, then fund the Roth requirement last?
For the catch up of 60, 63.
Yeah, for someone aged 60 to 63. I guess, Chris, my understanding there, as long as at the end of the year you have the appropriate amounts going to the Roth and the traditional, that's okay. Some might choose to break it up with each payroll, having a portion going to each, or some might choose, the first 9 months of the year to fund one and then the last 3 months of the year to fund the other.
Yeah, absolutely. And that question, I apologize if I'm not understanding, but it also might have to do with a new rule that went into place this year,
Yes.
to where if you were a highly compensated employee, um, you could put that first 24,500 in as pre-tax, but any catch-up contributions, so that 11,250 or that additional 8,000, that has to be made as a Roth
Correct.
contribution
So,
for starting this year.
so I think no concerns if you didn't have it set up at the beginning of the year, because there is flexibility. It just needs to be in the correct, what I'll call buckets by the end of the year.
So let's go to the next slide. And what this one is just showing us is now we had the doctor that just said, you know what, awesome, I got my $80,000 into the 401k plan. Is there a way for me to do more? Right? Is there a way for me to continue to contribute more money out of the business on a tax preferred basis or a tax deferred basis to the plan? And, our answer to that is then yes. And then what we typically do is we will start looking um, at cash balance plans more than anything else. And what a cash balance plan is, it is commonly referred to as a hybrid plan because it falls under defined benefit or your old pension type of rules, but it has a lot of the features such as being able to take lump sum distributions and stuff as a cash balance plan. And so what this does is we now have our personal contributions, our safe harbor contributions, and our profit sharing contributions all going into the 401k. And then we set up let's just call it a sister plan right next to it. That is a cash balance plan. And they're still tested together, right? They still have to be, working together, so to speak, as we go through this. But what this does is then it will allow, business owners, when you add in all of your 401k contributions and cash balance contributions, depending on age and income, we've seen it up to $430,000 of pre-tax dollars that you can take from business and move it to personal pocket, right? The cash balance contributions are always all employer contributions. Okay. So they're all used as a business expense at the company. Um, there's a few other nuances that we really just don't have time to go in depth into today. But what it will do is it will typically increase the minimum amount that you have to give your employees, right? So we knew with the 401k and profit sharing, that minimum amount's probably 5%. This probably increases that to 7.5 to 10%. So for really increasing 2.5, 3, 4% to your employees, an owner or doctor is able to significantly increase their contributions by hundreds of thousands of dollars in a lot of cases. Um, so what we're going to look at here in this example, now all of a sudden you can see, those same two doctors are now able to get, and we just used the rough number of $250,000 each into the retirement plans. Um, we're assuming that you have to give all the employees that 7.5% of whatever their W-2 wages are. So contributions to the two partners are $500,000 in total. Total contributions to employees, again, assuming that $1 million payroll amongst those employees is 75,000. Your gross tax savings is 230. So really, when you add up how much money you basically move from business into your own, personal retirement accounts and the tax savings, it becomes significant from year to year. So we have seen the implementation of these. I think right now we're implementing 5 different ones of these plans as we speak, increase significantly over the last few years. And it can also become a excellent tool when we have a couple of doctors or dentists who are getting older and, within 5, 6, 7 years of retirement, and it becomes a great way for them to really load up their retirement, before they transition the practice.
And the slide here says best suited for practices with strong cash flow and a focus on accelerated savings. I think that's really important because, the last slide when we were talking about the profit sharing, that is discretionary. You can do it 1 year and not do it the next, whereas this cash balance is more of a commitment. Can you touch on that, Chris?
Yeah, absolutely. So, when you implement a cash balance plan, uh, again, you're making a commitment from year to year to make sure that this is happening, right? And, while there isn't a hard and fast rule of how long you have to keep one of these in place, we typically say 5 years, right? At a very, very minimum, maybe a 3-year commitment to do it. So, if your cash flows are fluctuating drastically from year to year, it's probably not the right plan for you. But if you do have continued, strong cash flows and you can make a commitment to making these contributions from year to year, it can be an excellent tool.
And then say, I'm in a medical practice. We have an employed physician who's looking to buy in the next year or two. Does that pose any issues from how the cash balance plan is set up?
It doesn't. They're very, very flexible. Again, the key is really just working with people who have expertise on this. There are practices that we have where we have older physicians and then, to yours, somebody in their 30s, right? And there are ways for us to, exclude that 30-year-old highly compensated person from this plan, and make up things in different ways.
So I think Chris already kind of touched on this throughout his other slides, but these company contributions are employer expenses. So they are reducing the net profit of your practice and helping you from a tax perspective. These design decisions should align with your cash flow because, like we've mentioned, there are different levels of commitment with each different plan structure. So it's really important that those two are aligned. But then, if you do not currently have a plan in place, there are tax credits for newly established plans that can really help to, pay some of those fees in the first few years.
Yeah, there are. So that was a good point. We didn't really touch on that, but there are, if you have a practice that does not have a retirement plan in place today, when you implement a 401(k) plan, there are tax credits that are now available, and we're able to send you what those are. But they really fall into two different categories. One, there's tax credits up to $5,000 a year for 3 years for the administrative costs that go along with operating a retirement plan. So most of the time for most medical practices, uh, those tax credits are going to cover almost all of those expenses. And then there's a second group of tax credits that are available, which help handle your employer contributions. And those tax credits go for a 5-year period of time. And again, we can tell you what those are, but typically they can be up to $1,000 of your contributions to non-highly compensated employees. You can get tax credits for those in varying amounts, really over a 5-year period of time. So it's a great way for you to use, government money to start and, get your 401(k) plan off and running.
So now we do have a polling question for anyone who is looking to receive CPE credit from this webinar. Perfect. Okay. So now that we've talked about some different plan designs, we are going to dive into some different plan structures.
Yeah, absolutely. So what most people are familiar with, and we're going to touch on this very, very briefly, because it is a fairly new concept. But mo what most people are familiar with is your practice, sponsoring your own 401(k) plan, right? And then making all the decisions from a plan design that we just talked about. And also, then the responsibility to operate the plan in accordance with all the rules falls on your shoulders, right? Oftentimes, you will hire various providers, and we kind of have them here in this illustration, right? Whereas in a single retirement plan, right, you have yourself, right, as the plan sponsor in the middle, right? And that really just means, the buck stops with you, right? Oftentimes you'll hire a record keeper, right? So this is the website that you log into. This is where your employees log into. They're really the accountant for the plan, right? So making sure that they're looking at, pre-tax dollars, matching dollars, profit sharing dollars. They're allocating all of that, keeping track of your investment gains, investment losses, whatever it may be, right? They're serving that purpose and they're serving that role. You'll have a third party administrator that will help on the administration or legal side of things, right? Provide you your plan document. And then that's where you'll make a lot of your decisions. They might provide you with notices that you have to provide to your employees, help you with your tax 5500 forms at the end of the year, compliance, those things. Um, you have a trustee, oftentimes that's you as the plan sponsor, and a custodian of where the money is actually held, right? And then depending on the size of the plan, you may have to have an audit every single year. And then, from the green standpoint, we just have Lutz Financial there, but oftentimes people will have an advisor that will help with the selection and monitoring of the various investment options. Within a single plan, oftentimes most of these people are not working in what we would call a fiduciary capacity. They have the ability to do that where you can delegate some of that responsibility to them. But I always tell people that's something that if you haven't looked at in a while, look at those service agreements and make sure you are. Of the 170 retirement plans that we deal with, we work in a fiduciary capacity on every single one of them from an investment standpoint. That is becoming much more common than it was, 15 or 20 years ago. Uh, but it's not everybody, right? So single employer plan gives you the most flexibility, um, but also comes with a lot more responsibility on your end.
And Chris, just for people who maybe aren't aware of what those responsibilities might be, like what administrative tasks are there going to be yearly, monthly, quarterly with the plan?
Yeah, it depends on the type of plan and it depends on the provider, but things like tracking when your employees become eligible and notifying them, right? Or approving distributions or loans from the plan. Helping with year-end compliance type of things, making sure certain legal notices that have to be sent out every year are being sent out, right? Those are all a lot of the things that you're responsible for. And if your advisor is not working in a fiduciary capacity, it's your responsibility to select and monitor the various investment options that are available to your employees. Um, Good question. So, what we have found within our conversations um, is there's this new type of retirement plan structure that became available in 2021 with the original Secure Act that was passed. And you can most commonly possibly hear it referred to as a pooled employer plan or as a PEP. And for the first time, what it did is it allowed companies of all different shapes, sizes, industries, areas of the United States to join one professionally run retirement plan. And so what it did is it created this new role called a pooled plan provider, which is a professional. Oftentimes it was one of those, third party administrators who structured a plan and they take on the administrative responsibility and the hiring of all the various fiduciaries. So when companies decide to join one of these, they become a participating employer in this pooled employer plan structure versus having to sponsor their own. So they're able to delegate as much responsibility as they absolutely possibly can to professionals. Most of the time, the reasons behind it are one, again, it allows them to not have to be a expert in all things 401k and to focus on running their practice. Two, it can create some economies of scale as it relates to costs that are associated with the actual retirement plan. As an example, our own plan here at Lutz is in the Lutz Pooled Employer Plan, and we're able to get access to investments at institutional pricing that we wouldn't be able to if we had our own plan, right? Because we're pooled with, 66 other companies within it. But again, same structure that you see over here, the difference is no longer is your company in the middle, right? This is just there's multiple pooled employer plans that are out there. This is just the one that is the Lutz Pooled Employer Plan, where a Census and Newport are the administrator that are sitting in the middle. They handle all the compliance, the record keeping. They are the trustee, the custodian. They're the named fiduciary. Lutz handles all the investments, financial wellness, education for employees. If your plan is big enough, you no longer need an individual audit. If you're a member of a pooled employer plan. So we've started to see, especially as practices of transition to the next generation, a lot of the younger doctors, younger owners making those decisions to delegate these type of things, really to enhance the retirement plan and so they can focus on a practice versus what we saw with that older generation. So always happy to have discussions on what one of those structures is right for you, right? And that's what this is going through. On the left, you can kind of see some of the points for a custom and individual 401k plan, right? So designed by you, right? Greater flexibility in plan design, you know, you as the employer selecting and overseeing the vendors, right? So that's your responsibility. You have more control over features and contributions, higher administrative and fiduciary responsibility. Um, when you look at the pooled employer plan, there are multiple companies that participate in one plan. That's where some of those economies of scale come into play. So there's centralized administration and oversight. Plan costs are really shared amongst all employers. Um, that's partly true in the fact that it allows us purchasing power right on there, so we can reduce costs typically overall, reduce administrative and fiduciary burden. Um, and the plan features that we just talked about in this, and most of the plan features, I would tell you, from an eligibility from a plan design, 95% of all current plan designs fit within a pooled employer plan structure as well. So, a question that we're commonly asked is, hey, if I'm participating in the pooled employer plan, do I have to have the exact same eligibility and plan design as all the other employers? And the answer to that is no. Each and every participating company gets to pick and choose their own.
So I think, even though for the custom 401k plan, it says best suited for practices prioritizing customization and control, there is some customization still available in the pooled employer plan. So it's definitely worth a further discussion and not just saying, oh, if I need the custom, I need to go down one route versus the other.
Yeah, that's a great point. When you see the best suited for pooled employer plans where it says simplicity, that simplicity is more than anything referring to the simplicity on your end from an
Mhm.
administration standpoint, right? You're not having to figure all of this stuff out and take responsibility for it. So we really are still able to customize employer to employer.
And that's probably where it's plan design versus plan structure. When we're looking here, we're more comparing two different plan structures, but the plan design can still be customized within that.
Absolutely.
Okay, we want to quickly go through a case study and then leave some time at the end if there are any questions.
Absolutely. We can send this case study to everybody, but this is a case study that we've recently gone through with a client of ours. And it's again a busy medical practice, right? Two physician owners. They had about 34 employees at the time of doing this. They had a 401k safe harbor plan with a match, and the match is the only thing they were doing, right? No profit sharing. Um, the participants that were participating in there paid all the plan expenses, right? When you sponsor a 401k, uh, it's not free, right? There's different administration that goes onto it and there's expenses. And there was limited employee education. There wasn't a lot of people there to assist the employees with it. And they were taking on full administrative responsibility, right? They had a third party administrator that was just providing them with notices, doing those things, but ultimately it was the practice's responsibility to make sure that was being done appropriately, right? Very, very, very common fact pattern that we see with a lot of medical practices today. So, challenge, right? So, current advisor that they had working on their plan was what I would call more of a general practitioner, right? So 401k and retirement plans weren't the only thing that they do. They were doing individual wealth management by day, 401ks by night. Really didn't have the time to become an expertise in the retirement plan side. Um, Again, I just touched on it. Plan design wasn't as efficient as the doctors wanted. Uh, the cost structure. So oftentimes in medical practices, right, uh, the vast majority of the assets in the retirement plan are those of the medical professionals, right,
Mhm.
of the doctors. So they're already paying the vast majority of the expenses. Um, how do we make that more efficient? They wanted more employee education. Um, Again, they were spending the practice administrator is spending a lot of time on the administration and compliance oversight. And then again, the design again was not there to maximize the doctor's goals of maxing contributions. So what we did is after reviewing the current document, right, we implemented a safe harbor non-elective plan, right? So we changed it from the match to the 3% non-elective. We changed the profit sharing formula. It was just pro rata, meaning if the doctors gave themselves a 5% profit share, they were going to have to give everybody else a 5%, right? And we moved it to that new comparability with everybody in their own group, like we just talked about. Um, from a tax savings strategy and a cost strategy, we took all of the costs of the retirement plan that we could, and we moved them to being billable at the practice level, right? So the doctors were already paying all the money. It was just coming out of their 401k accounts. Now they're able to write a check on a quarterly basis for those, and it becomes a business expense and allows their accounts to grow faster. Um, they moved into the pooled employer plan, right? They knew they had a practice to run. The administrator, we wanted to free up time on his end. So we were able to move into the pooled employer plan to simplify that. And, we started doing, pre-shift group meetings for all of the employees, meetings over lunch. Um, the practice spends a lot of money in contributions for these employees. We wanted to make sure that it's working for them. And, by changing a lot of this, it really allowed us to put more money into the doctor's pockets, but it also increased what the employees were giving by about a 0.5%. And and this is the impact from just a dollar standpoint, right? So um, total employer contribution when we ran this and did this, it's obviously changed over the last year or two, but was 160,250 was the total employer contribution. So of that 81,000 combined employer contribution to two employers or to the two doctors, right? Um, that was just the employer piece of it, right? So there was about a $64,000 tax savings that went there. Again, not including their own personal contributions that went to it. Um, when we looked at then also moving the plan expenses out because of the size of the doctor's accounts, really from a year to year basis, um, there was about $15,150 at that time uh, that we saved on a year to year basis that from those two doctors, right? That's how much they were personally able to save every year and lowered the expense that the employees were paying inside of their own accounts from about 0.69 down to 0.12. So it really made a huge impact and was a win-win for everybody. This was, a doctor's group that um, it took a little convincing to take a look at their practice or to take a look at their plan in the first place because it was one of those, if it's not broke, don't fix it. Again, you know, they've just had the same plan in place for, 10 plus years and, didn't realize what questions to ask or what they didn't know what they didn't know.
And at this time, we would take any questions, but I also think, Chris, that's a great segue. You and your team are willing to do a complimentary review and discussion of someone's plan and talk through what other options they might be missing, where there could be savings or enhancement opportunities.
Absolutely. So we're always willing to do that, no cost, to take a look and see if there's any ways that people can enhance it.
Perfect. Okay. It doesn't look like we have any questions. We'll wait around for a few minutes in case anything pops through. But thank you for joining, and please reach out to either Chris or myself if you have any questions.
Thank you.